Bloomberg Television's own Stephanie Ruhle is joining me now, and we're going to examine some of the details. We've got Doug Borthwick, Managing Director and Head of FX Trading at Faros Trading. Doug, what does the agreement signal about Europe's commitment to economic reform?
What does it signal? I think it signals for the first time that there is some sort of agreement of reforming their economies. It looks to me like everyone understands they need to get their act together, that finally Italy, Spain, even France realize they need to raise the retirement age. They need to get rid of some of the public sector. They need to privatize industry. And for once they understand they need to get rid of the bloated deficits that they've been running.
How confident are you that, I understand that they agree to it, that they can actually implement this? When they go home, are they actually going to do anything?
Well, what's interesting is that the discussions they had were heated. And normally when you want to find an answer to something, you have to have a heated discussion. There was not a lot of diplomacy here. There was heated discussion. And within that heated discussion, yes, certainly they need to do something. Now, what's interesting is with the recapitalization of the banks, it's looking very likely that if they don't follow the path they've said they will, then they won't have access to EFSF money. And so they won't be able to recapitalize their banks with that money.
Is this the first real threat?
It's certainly the first real threat, but I'm sure there would be more. Van Rompuy has been talking about moving towards more fiscal unity. And in a move towards more fiscal unity, you have to do more things together. You have to be much more within sort of the German system when it comes to economics as opposed to maybe the Greek system of economics.
What kind of details have you heard on this European Financial Stability Facility and moving it from something that's got 440 billion euros to something that's got 1 trillion euros? That's a big difference.
It's a big difference, and it's going to be through leverage. Obviously, what I understand is very similar to what everyone understands, and that's that there's a leverage quotient to it. That leverage quotient is going to be dependent upon an IMF-led investor base. It could be from reserve managers around the world. Certainly, China was given a call by Sarkozy today, and Hu Jintao, I guess, is looking at it. But whether he will or not, is really down to the wire. However, we do believe they will. And certainly China 2 weeks ago did say that they want to see the size of the hole in Europe before they start to fill it. It's in China's interest to have the euro stabilize and move higher. One, because Europe is obviously their #1 trading partner, not the U.S. But two, in order for the Chinese renminbi to strengthen, the euro has to go higher.
How important is a call from Sarkozy to China? China has their own problems to deal with.
Well, I think they were really expecting the call, right? I'm sure they've had lots of calls from Sarkozy. They've probably had calls from the U.S. Treasury Secretary Geithner as well. They
didn't want to let their answering machine take it today?
No, probably not, because, everyone's always talked about China, the white knight riding to the rescue. Obviously, they don't want to come in and invest in something if it means they'll lose money. But China, remember, has been long dollars and short the euro from 160 back in 2008 when Lehman went under. So really, they've been very anxious about how prudent it is to have all of their reserves 65 to 75% in the U.S. dollar. This is a great way for them to be able to purchase something that can then get them a little bit more reserves out of the U.S. dollar and into Europe.
Talk about purchasing, what is it? Purchasing bonds that would be issued by the European Financial Stability Facility or some construct?
That's right. Well, either issued by the European the EFSF, or else by the EMF that they would then be purchasing. Obviously, all the details are murky right now. You're right. There's a lot of bones and there's not a lot of meat. But in our view, that meat will get filled in rather quickly, especially before the G20 meeting.
All right. Our own Stephanie Ruhle is with us. Also, we've got Doug Borthwick, Managing Director and Head of FX Trading at Faros Trading. And joining us, Bob Gelfond. He is the founder and Chief Executive of MQS Asset Management. Bob, a pleasure. So what do you make of this agreement on a plan whose details have yet to be worked out?
I'm a bit skeptical. The real source of problems in Europe is not the temporary liquidity crisis. It's what's causing the problems, which is the structural issues in the European economies. And until we see real reforming their labor laws, reforming their pension systems, selling off state assets, and so that we actually see that start to happen, I'm going to be skeptical that the problem is solved. It was interesting today that, despite all the news, there was still a tightening in spreads, Italy to Germany, Spain to Germany.
Explain what that means for people so that they understand this idea of tightening spreads and comparing the cost of government debt in Italy versus, let's say, Germany.
Sure. Both countries denominate their debt in euros now, of course. And in theory, if the sovereigns aren't going to default, which is the company line from all the from the European Central Bank and from the governments, then they should be trading at the same yields. The reason they don't trade at the same yields is because the markets don't believe the governments and perceive there being a risk to getting paid off. The Italian yields, Spanish yields, and of course the Greek yields have been off the charts, and that spread between German yields and these other countries is a measure of risk, credit risk in those countries. Now that risk is narrow today, but still in the scheme of things not by much. The 2-year German rates are roughly about 65 basis points. Italian rates are still over 4%. Spanish rates are about 3.5%. So that tells you that the market is still somewhat skeptical that things are all solved and happy days are here again.
You want it wrapped up in a package all at once, don't you?
I want them to address the real problems.
Oh, come on. This is going to take decades. We know this. Doug Borthwick, comment on this. We're not just the only ones that have this problem. I mean, this is a global issue, right? I mean, there's too much debt. We got this in the United States. It's not something that's going to be solved in a summit meeting on a Wednesday night.
Absolutely. I think that if you're in the market and you're expecting Europe to fix the short-term issue and their long-term issues in one meeting, then obviously that was an incorrect assumption. But what we do expect now, and what we think now, is that Europe's putting itself on a more equal path to the U.S. in that what they're doing is they're fixing their shorter-term fiscal issue and making it a longer-term fiscal issue. And while we talk about downgrades in EFSF or we talk about downgrades in France, S&P came out today and talked about a possible downgrade again in the U.S. And so, it's on an equal footing. And when you buy the euro or you sell the euro, you're doing it against another currency, and that, in this sense, is the dollar. And so now when you're looking at the longer-term fiscal issue, people have to decide, well, do I want to be in Europe, where Europe is essentially getting their house in order when it comes to finance, or do I want to be in the U.S., where the U.S. right now in the super committee hasn't really made any decisions yet?
Tell me about the euro versus the dollar. I remember you've been on the program recently. You've been talking about how the euro is going to increase in value against the dollar. That call has come to fruition, 141, 142. Great call, made people a lot of money. What's next for the euro?
I think the euro continues to go higher. As our guest has said, you saw spreads come in a little bit, but they're not really moving. The market still has not yet to digest this and really believe that this is the right move. And you've seen guys, if anything, today selling euros on the rallies, whether it's at 139, 140, 141, 142. The market is still in this, is really married emotionally to the fact that Europe has to go lower and the euro has to go lower because of that.
Why are they married that way? I mean, because as Bob says, they want some kind of big overreaching plan that's going to solve all the problems at once. I mean, do you think that it's possible, Bob, that the euro just creeps higher because you got repatriation of euros from European companies and banks that maybe are selling assets? And also, as Doug was saying, you got the Chinese coming in. They want to diversify their reserve currency basis.
There's a lot of things, and as Doug pointed out, it's a relative value bet between the dollar and the U.S. and things, while not falling off a cliff here, are certainly not in great shape.
But also, even though we're not solving a problem, we have extended the amount of time, so doesn't it give these countries more time to help solve their own problems?
It does, but there's no evidence that they're actually going to use that time wisely. They use the time to worry about the next crisis or not worry about it, and then the next crisis comes up. And the problem is, of course, is that I think the economist Herbert Stein once said, when you can't keep on, when the inevitable has to happen, eventually it happens. And unless you're going to really address these issues, that's going to, a crisis is going to happen, even if it may not happen today or next week or even next year. They have to address these issues. We have to address them also.
So do you think, even though we didn't see credit default swaps triggered today, do you think they could be triggered in 6 months, or you think they're never going to let this happen?
I think the governments have pretty much laid their cards out, and they're not going to let these CDSs get triggered because they don't.
These are basically insurance contracts, right? You get to insure your debt. You insure your debt against the loss.
So the fact that they didn't allow them to be triggered, do you think that's making these an invalid instrument? If they didn't let them trigger today, you don't think they'll do it tomorrow,
I think a lot of
point?
people who thought they might have had hedges on their bond positions are surprised at what's going on. I don't think they should be, but...
You thought you had house insurance, your house burned down, and the insurance claim agent said, well, page 362.
Exactly.
Sorry, fine
Exactly.
print.
So, and it's also unclear. It's possible that some of the banks that they're looking to protect may have these CDSs on too as hedges. So if the hedges are not going to be good, what does that say for portfolios if you're looking to hedge your portfolio? And it may complicate what's going on at these banks as well.
Doug Borthwick, want to give you a word here. When you look at what's going on with the euro and the dollar, how hard do you think the euro can go versus the dollar?
Well, look, we moved from 132.50 to about 142 today, and that's really on the back of shorts getting squeezed out of it. We see tremendous amounts of money on the sidelines from central banks that are looking to get back into the whole recycling effort. As dollar Korea comes lower, dollar China comes lower, dollar India comes lower, the central banks will be coming in there buying dollars against their currency, then selling the dollars and buying the euro. We see tremendous flows that are coming in now from French banks, German banks that are taking money that's overseas, selling their assets overseas and bringing that money back. That's more euros. Today we saw model funds today switch from the first time from going short euro and short Aussie dollars to buying euro and buying Aussie dollars. So you've got a tremendous now flow, and plus we closed above the 200-day moving average today, significantly above, which means that momentum now is going to start moving it higher too.
All right, Brett Holleman, good to have you with us. What do you make of this plan? You know, Doug seems to think that this is a good first step. It's significant. Certainly stock investors are cheering the news.
Well, I think that from a quantitative standpoint, it's a good first step. For the first time, they've actually put a number on the board that could potentially solve at least the Greek problem, possibly the Greek and Portuguese problem.
This is the trillion euro. This is the trillion euro
package,
European financial stability facility.
The fact that you've said could, possibly, and at least. None of those are definitive.
No, they're definitively bearish. I think that the real problem is that structurally, as an entity, the EU is legally too complicated to get anything done. The problem is not a matter of having the will or the political power or the financing to get something done. The problem is actually implementing it within the legal and political infrastructure that the EU provides. You know, you basically have 17 guys at a table, and each one of them has a veto. That's a very, very hard situation to manage.
Yeah, but Doug Borthwick, come in on this. I mean, it seems as though European leaders, as you said, they're able to thrash out some agreement, and if they have to change some of the treaties, they will.
Well, you know, I don't think it's not necessarily the individual country leaders that decide on how to change the treaty. You know, I think that it's something that's much more overall. I think Van Rompuy, you should have on your show to talk about that. But when it comes down to the legal aspects, certainly France has their own legal system, Germany has their own legal system, and they all have to answer to the European legal system. So it is a disaster. It is a bit of a nightmare, and that's why I think people are less willing to jump on this trade and say, you know what, here it happens. Now, I'm of the belief that whether it happens today or whether it happens in a week's time or in a month's time or in 5 years' time, that's sort of irrelevant.
You actually think it can happen, though?
I think I certainly think it can happen. Now, the market in the U.S. wants it to happen right now or tomorrow.
Even here in the U.S., I mean, the Volcker Rule is a 400-page document with the word exclusion on, I think, 100 pages. You know, Dodd-Frank hasn't been written. As soon as you get into the legal side of it, you just get mired down into things really happen.
How long did it take for TARP to get enacted? And how many pages was TARP? I think TARP was 3 pages, and it happened pretty much overnight.
I'm glad you brought up TARP, because as an example, Brett, I just want to use this and say, all right, we've been through this experience in the United States to a certain extent. The U.S. Treasury pumping money into the financial system. Banks in Europe, they've got to recapitalize. We've done 2, some people may even say 3 versions of quantitative easing. Don't you think that what the European Central Bank and the leaders of Europe are trying to do you think that this will help the economies of Europe?
I mean, no, I don't think they'll help the economies of Europe because they all suffer from a structural problem, which is simple. It's just demographics, right? They grew for 75 years with expansive social programs and security nets while the population was growing. Now the dependency ratio is changing because the birth rate in Europe is much lower than it is in the United States. No, the outlook for Europe for the next 25 to 50 years is horrid. You know, you look at Greece, for example. Greece is the first country in modern history that will effectively default, depending on, you know, whether we're going to call it a default or not, effectively default on its debt with a primary budget deficit. Every other country runs a primary budget surplus, and the reason they default is because they don't control their currency and it's non-local denominated debt, and because they have interest payments they can't afford to pay. That's not the case with Greece on either count. With Greece, it's a simple matter of they collect $1 and they spend $1.15.